Hello everyone, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
And friends, today we are going to learn a tutorial on spin-off versus split-off. Is it same thing or is it a different thing? See, separation is never easy. It brings along plethora of emotions ranging from grief and angst to relief and freedom. Akin to human lives, corporate entities also go through various phases of restructuring, which sometimes calls for separation. But it is imperative that the separation happens for the right reason. Only then will the company reap benefits. In this tutorial, we'll discuss so many concepts on this. We'll start with the reason for the divestiture as first. See, disinvestments or divestitures is a phenomena in the corporate landscape that entails partial or full disposal of the business unit with an intention of focusing on more profitable or core models. As companies climb up the growth trajectory, managing diverse business lines becomes quite challenging, and hence pruning to the portfolio becomes an obvious choice. Some of the reasons that justify divestiture are financing issues or to exploit to the full potential of each entity as opposed to the consolidated entity. These are some of the reason. The reason is to focus on the core operations, to address the financial or liquidity issues. They want to scale up to the maximum profitability or separate operations for better management, so decentralize the things, to emerge out for the bad acquisition, and to gain tax advantages. Divestitures can take various forms like spin-off, split-off, or equity carve-outs. However, it will all depends on the reason for the corporate restructure. Usually, the business lines are that are divested are one that have least synergies with the parent company. So, what is spin-off? In a spin-off, the shares of the subsidiary company or the company being spun off is distributed as a special dividend by the parent company on a pro rata basis. The parent company usually do not receive any cash consideration for undertaking the spin-off. Existing shareholders enjoy the benefit of holding shares of two companies instead of just one company. The hidden motive is to allow the spin-off to have distinct identity from parent company's management. Sometimes the parent company spin off 100% of its shareholders shares in the subsidiary, while at times it may just spin off 80% of its shareholder and retain a minority interest of the holding. In fact, one of the prerequisites of a spin-off is that the parent company must renounce control of the subsidiary by distributing minimum of 80% of its voting and non-voting shares. Let's see some of the traits or features of the spin-off. First, a parent company distributes the shares of the subsidiary in the form of special dividend. Second, the stockholders share in both the companies. Third, two independent companies come into existence. Fourth, effective removal of the parent company from the management and decision making of the subsidiary. So there is 100% parent, and there is there's a stub breakup of 75% and 25% breakup. I'll show you that. As you can see, there is a breakup of 75% of the breakup value and 25% of the breakup value, the spin-off and stub. So once the subsidiaries are freed from the control of the parent company, one can see fresh streaks of entrepreneurship at play. The independent new company usually operates with more accountability and responsibility. Let's see some of the example of spin-off. Have you heard about Kraft Foods Mondelez spin-off? I'll tell you something about it. In October 2012, Kraft Foods Inc. spun off of its North American grocery business, Kraft Foods Group, in the corporate action, which entail distribution of the ratio of one share of Kraft Food Group common stock for every three shares of parent company's common stock. Kraft Foods then renamed its snack division as Mondelez International, which houses brands such as Oreos, Cadbury, Wheat Thins, Ritz, Trident. The grocery company was renamed as Kraft Foods Group, which focuses on grocery brands like Oscar Mayer, Nabisco, Planters in North America. I'll show you some article on the same. Now, this was the article. It says that in October 2012, Kraft Foods completely spin off the Kraft Foods grouping. Okay, and you can see the Kraft Food also changed the name on 1st October 2012. Ticket has been retired, and there is no action required on the part of the respect into the shareholders of Mondelez International common stock. Therefore, the post spin off, you will own only one share of Mondelez International and 33 shares of Kraft Food grouping. For every share of Kraft Food that you currently own, in addition, you will receive cash in lieu of transactional fraction share of KRFT. See the possible reason. The snack in the confectionery business had a wider exposure to high growth emerging markets, while the grocery business was more North America oriented and stagnating. Therefore, to exploit best of the both worlds and to manage two different segments in a focused way, the spin-off was undertaken. The another example was the second called Baxter and Baxlata spin-off. In 2014, leading healthcare company Baxter International Inc., that's known as Bax, spun off of its bioscience arm called Baxleta Incorporated BLXT. As per the term of the idol, Baxter distributed 80.5% of the outstanding shares of Baxleta common stock and retained 19.5% ownership stake in the company. For each share of Baxter common stock held, shareholders received 1 shares of Baxlata common shares. This was the article which says that Baxlata said it will be built on strength of hematology and immunology while seeking to expand its portfolio for patients with limited treatment options. The new company aims to build its base of 6 billion in annual revenue, saying its plans to generate an additional 2.5 billion in sales through launch as well as new indication for existing products. As a part of Baxter the spin, the company received 7 approvals for new products over the past 2 years, and it begins a life for 4 products under the regulatory review across its 3 areas of therapeutic. So, possible reasons behind this: both of the business operate in distinct market and had different risk profile. Baxter was primarily specialized as a medical suppliers company, and combination with Bioscience, a completely a different portfolio, was making it difficult for operations and valuation. Therefore, the management saw it is in the best interest of the company to spin off non-core arms. If you can see this graph, these are the number of the completed spin-off of the year. Okay. As you can see, the number was quite fluctuating. It started from 1985 to 2015. It had a stiff rise of 60 in 2014. There was a massive fall to 40. There was a decrease in 20, which number doesn't seems to be good. So let's see the type of spin-off. Due to variety of the reasons of restructuring and plethora of the reasons behind doing so, spin-off manifests itself into various forms. In various forms. Some of the common ones are: first, pure play. See, pure play is is the most original form of the spin-off. This involves shareholders distributing shares of the subsidiary as a special dividend. Both of the companies have common shareholder base. This method is stark contrast to an initial public offer, in which the parent company actually offloads some of all of its ownership in the division rather than just diverting it without any cash consideration. Pure play have gained momentum post 1990. The emerging competitive landscape motivates the management to enhance operational efficiency and hone strategic decision making skills. Second, which is known as the equity carve outs. Many people confuse carve out with the pure play. However, there are minor differences between the two. In carve out, the parent company sales an interest of the less than 20% in the new subsidiary in registered public offerings for cash proceeds instead of just existing shareholders. This is also known as partial spin-off. When a corporation needs to raise capital, selling off the portion of the division while still holding control proves to be a win-win situation for the company. There are other motivating factors also behind carve-out as well. Sometimes a company might feel that a particular division has been hidden potential and might perform well once it is spun off. A separate stock garners more attention and enables the investor to value the business independently. Third, which is called as tracking stocks. As opposed to the spin-off, where a division goes separate from the parent and establishes itself as a financially and managerial autonomous company, tracking stocks represents shares that are still very much a part of the parent. There is no legal split of the assets and liability. The parent and tracking stock have a common management team and board of directors. However, the tracking stock represents separate financial reporting and analysis from the parent company. The tracking stocks score some advantage to the issuer over the spin-off, issuing them in a tax-free procedure, and if one of the two units undergo financial loss, the earning from one would make good the losses for the other for the tax purposes. So if a parent company enjoys a higher credit rating, the tracking stocks can reap the advantage of the lower borrowing cost. The more the synergies between the parent and the tracker, the higher the advantages. Basically, these stocks are issued with the sole purpose of gaining from the higher stock prices of the parent. Fourth is called Stubs. When a company distributes shares in the subsidiary to the public while retaining ownership to some extent, it is known as partial spin-off. Once the spun-off or the subsidiary becomes publicly traded, we can determine the market value of the investment of the parent company in the subsidiary. So, if we subtract the intrinsic value of the subsidiary from the intrinsic value of the shares, we can arrive at the value of the core operation of the parent, also which is known as stub. So, split off, it is a distant cousin of the spin-off. We spoke enough about this spin-off, so now let us also shed some light on split-off, which is a distant cousin of spin-off. Conceptually, both are the form of the divestiture, but there are differences between the corporate structures reorganizes themselves. Split-off means restructuring an existing corporate structure in which the stock of the business unit or subsidiary is transferred to the shareholders of the parent company in lieu for a stock in the later. While on the other hand, in spin-off, stocks in subsidiary are distributed to all the existing shareholders just like the dividend. I'll show you a graph on the same. Can you see this graph or how the things have been done? Have a look at that. In split off, the parent company gives a tender offer to its shareholders to exchange their shares for new shares of the subsidiary. This tender offer usually gives a premium in order to encourage the existing shareholders to go for the offer. The privilege of the premium tells why split off usually ends up being oversubscribed. If the offer is oversubscribed, it means that more of the parent shares are tendered than that of the subsidiary. When the shares are offered, the exchange happens on a pro rata basis. On the flip side, if the tender offer is undersubscribed, it means that too few shareholders of the parent company have accepted their tender offer. The parent company will then usually distribute the remaining unsubscribed shares of the subsidiary on the pro rata through a spin-off. Can you see some examples of parent and subsidiary company AT&T and AWE, which happened in 2001 of 7.8 billion? Percentage of the shares repurchased 10%, initial premium 7%, closing premium 1%, and oversubscription by 87x. So these are some of the example like Sarli, Coach, and so on and so forth. So split off example, DuPont concourse of split off. In October 1998, DuPont generated 4.4 billion from the initial public offer of 30% of the shares of the 𝐒𝐭nco unit. DuPont, through its proposed stock swap, planned to divest itself of its remaining stake of 70% in 𝐒𝐭nco. In 1999, the former then designed the plans for a final split off from 𝐒𝐭nco Inc. oil unit, offering to swap 𝐒𝐭nco's stock worth 11.65 billion for about 13% of the DuPont shares outstanding at the time. This IPO was touted to be one of the largest in the history. You can see this article of DuPont. Now the company is shedding the remaining 70% of the 𝐒𝐭nco through a stock swap with the shareholders before the end of the year, rather than calling the transaction a spin-off, where the shareholder usually receives the new shares of the company being sold, and is called the transaction a split-off because of the stockholders will have with the choice whether to swap their shares or not. Okay, so possible reasons behind is that 𝐒𝐭nco was a strong and steady contributor to DuPont's revenue and cash flow, but DuPont felt it was in the best interest of both the companies to operate as a separate entities and scale new heights. DuPont wanted to concentrate on its material and life science business, while 𝐒𝐭nco wanted to explore the imminent growth in the energy markets. Lockheed Martin and Martin Marietta split off. Lockheed Martin, this is one more example, Martin Corp announced a plans to split off of 81% of the interest it was holding in Martin Marietta Materials Inc., a highway construction material producing company. This split off was aimed to provide Marietta Materials immense opportunity to pursue its growth strategy and finance the acquisition it has planned. As per the terms of the split off deal, for 472 shares of the material common stock for each shares of the Lockheed Martin common stock was distributed by the latter. What are the possible reasons? Lockheed was into substantial debt pile estimated around 13 million, and the move would generate enough cash to service the debt. Similarly, Martin Marietta Materials would be able to plan more inorganic growth through the acquisition mergers. So let's see the tax treatment for the spin-off. Spin-off earned brownie points for the being tax-free options. However, that not the case always. Whether a split-off will be tax-free with or with taxable is decided in the manner which the parent company divests the subsidiary or the part itself. The tax perspective is governed by the Internal Revenue Code IRC section 355, while the financial viability is the key driving force behind the split-off. It is also imperative that the shareholders' interest is taken care of. Usually, divestiture attracts a long-term capital gain, and hence the split-off has to be designed in such a way that they are tax-free. One method is to ensure that the distribution of the shares in the new spin-off to existing shareholder indirectly proportional to their equity interest in the parent. If a stockholder has 3% holding in the parent company, his shareholding in the spin-off company will also be exactly 3%. So in the second method, the parent company offers an option to the existing shareholder to exchange their shares in the parent company for an equal proportion of the shares in the spin-off company, or continue maintaining their holding in the company. Some also exercise the option of the holding both the stocks. This is something on the lines of the spin-off. Let's make the final conclusion of this. On this, a spin-off or split-off or equity carve-out are the three varied methods of the divestiture with the same objective: enhancing the shareholders' value, tax benefits, and improved profitability. Well, the goal of all of the three methods is same. The selection amongst them is based on the broader corporate strategies of the parent company. Exit strategies are usually peppered with various challenges. Carving out the company, which is different from the core operations of the company, requires thorough due diligence. A well-aged analysis of the strategy can build confidence in the process, get perfectly aligned operations, and drive the entire transaction to realize the highest potential. Separation complexity are onerous and involve negotiation at each step. A preconceived transition plan which clearly spells out the entire process, and the work involved at each stage would go a long way in keeping things streamlined. Next is focusing on the compliance perspective. The spun-off company should adhere to the prevalent financial reporting norms and be compliant with the other internal and external control as well as the regulations like Sarbanes-Oxley's Act, SOX Act, SEC filing, etc. The company's acumen to identify these challenges and underlying risk factor at the right time in the planning phase, which considers the key value drivers behind the divestiture, will lead to increase value generation from the chosen existing strategy.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.